We are talking about incorporated businesses, and a question I sometimes get asked is, why is my tax bill so big? I haven't even paid myself. In this video, I'm going to break down the importance of a shareholder loan so that you don't unintentionally screw yourself. So what the heck is a shareholder loan? At its most basic, a shareholder loan is an account in your bookkeeping records. It tracks contributions and withdrawals from your corporate bank account. Let's go through a few examples so we can understand what this looks like. Jennifer recently incorporated, and to get her budding new business off the ground, she deposited $10,000 into her corporate bank account to handle upcoming expenses. This meant Jennifer created a $10,000 shareholder loan. Now her corporation owes her $10,000. Jennifer can withdraw these funds from her corporation at any point tax-free. In this instance, Jennifer's shareholder loan is benefiting her tax situation because it allows flexibilities on cash withdrawals. After a few years, Jennifer's business has really picked up steam, and she's created a healthy reserve of cash in her corporate bank account. Jennifer decides to take the $10,000 out of her company as repayment for her initial investment. Jennifer also decides to go on a well-deserved and lovely personal vacation to celebrate her success. She charges the $5,000 trip to her corporate bank account. Jennifer's shareholder loan is now overdrawn by $5,000. In other words, Jennifer owes her company. This can be problematic for Jennifer because the Canada Revenue Agency requires that overdrawn shareholder accounts be repaid within 1 fiscal year. This means that an overdraw shareholder loan account cannot appear on your corporate tax return 2 years in a row. Luckily, you have a few options to eliminate the loan. How to reduce your shareholder loan. The first option is to reduce your shareholder loan by physically repaying the money. Jennifer could take $5,000 out of her personal bank account and deposit it into her corporation. Despite being a great option with no negative tax consequences, the repayment method isn't the first choice for most business owners. The second option is to take the overdrawn balance into personal income. Rather than repaying the $5,000, Jennifer could take a non-cash $5,000 salary or dividend from her corporation. To have this option work, Jennifer won't physically take the cash because she's already done so by charging the $5,000 vacation to her corporate bank account. Instead, this is an accounting adjustment, and Jennifer will issue a T4 wage or a T5 dividend statement from her company, which she will include on her personal income tax return and pay personal taxes on. What if you leave your overdrawn shareholder loan account? If you decide you don't want to clear up your shareholder loan account, things can get a little messy with the CRA. The first year you leave your overdrawn shareholder loan account, the CRA requires you to charge imputed interest to yourself. This means your corporation records interest income at rates predetermined by the CRA. Your corporation must then pay taxes on this imaginary interest. You also experience a slight increase in your overdrawn shareholder loan account because the CRA expects you to consider this as money owed to the corporation. The second year you leave the overdrawn account, things get really nasty. The CRA can designate the overdrawn balance as a shareholder benefit. This means they allocate it to your personal income. What the CRA denies is a deduction from your corporation, along with any tax credits you would normally experience on wages or dividends. Essentially, this results in double taxation. Now, as a warning, housing loans taken by shareholders can also be subject to double taxation. Only in instances where a housing loan is available to all third-party employees might this be allowed by the CRA. Shareholders who set up housing loans often pay huge tax bills. This can take years to repay, and it ruins businesses. Don't get caught unaware. Understanding how your shareholder loan account works is one of the best ways to avoid surprise tax bills. Please heed this warning. Many clients get in trouble with this. Not understanding the importance of their shareholder loan has landed many with surprise tax bills that can be astronomical. This is devastating and can ruin marriages and bankrupt companies. A client of mine sold their company and personal residence just to pay their tax bill. If you decide to overdraw your shareholder loan account, keep a few things in mind. Number 1, consider if you should set up a regular payroll for yourself rather than haphazardly drawing out cash. This provides stability for personal budgeting and often reduces financial stress. Because of its benefits, it is a strategy that I personally employ with my business finances. Number 2, if you anticipate having a big personal tax bill, set funds aside. Saving 20 to 30% to cover that upcoming tax bill means you'll be well prepared. Alright, that's all that I have for you today on shareholder loans. I hope that this video was helpful and helps you avoid a surprise tax bill. Bye for now.